What if I told you that right now, in this exact market, the stocks that are going to make you the most money over the next 3 to 5 years are the ones the market is actively punishing? Not the laggards, not the broken businesses, the great ones. The ones growing 30%, 40%, 50% year over year, getting sold off because they dared to invest in their own futures. And while everyone is chasing AI chip names and memory stocks, a handful of absolutely elite businesses are sitting there at discounts that, frankly, I don't think will exist 6 months from now. Today we're going through 6 names. Some reported earnings this week with results that were genuinely impressive, and the market punished them anyway. Others have been quietly getting left behind in a momentum-obsessed tape. All 6 are on my list right now, either as buys or as names you absolutely need on your watch list. We've got Mercado Libre, Meta, Rocket Lab, CoreWeave, Irene, and Shopify. We're going to break down what actually happened in their earnings, why the market reacted the way it did, and, most importantly, what the right interpretation of that reaction is for a long-term investor. Before we get into it, if you're someone who takes investing seriously and wants more of this kind of analysis, hit subscribe and the notification bell right now, because this type of content, we're doing it every week, and trust me, you don't want to miss what's coming. Hit the like button too. It genuinely helps more people find this channel, and I appreciate every single one of you. All right, let's get into it, starting with the name that had the biggest reaction this week. Mercado Libre is down 12.8% today. And before you ask, yes, I know. Down 17% year-to-date, down 32% over the past 12 months. In a market that rewards AI and memory names with insane multiples, Mealy just sits there getting absolutely no love. And here's my honest reaction to that. Good. More for us. Now look, I know what you're thinking. Market cap $82 billion, trading PE of 43 times, forward PE around 136. That sounds expensive, and on the surface, it is. But Mercado Libre has always traded at a premium, and there is one very specific reason why. They are the only company, publicly traded anywhere in the world, that has grown revenue above 30% year over year for 29 consecutive quarters, 7 years, through different U.S. administrations, through South American economic turbulence, through COVID, through rising rates, through all of it. Every single quarter, 30% or more. And not only that, if you look at the recent trajectory, it's accelerating. 33.8%, then 39.4%, then 44.5%, and last quarter, 49% year-over-year revenue growth. So why is the stock down 12% today? Margins. The market hates CapEx cycles. Operating income fell 20% year-over-year, margin compressed to 6.9%, and the market looked at that and said, sell. But here's the context the market is completely ignoring. This was a strategic margin hit. Management chose to invest. Free shipping expansion in Brazil. Credit portfolio scaling aggressively. They are building, not harvesting. And they have done this before. Every single time they've made this choice, it has paid off. Let's look at the actual metrics underneath the surface. Brazil GMV up 38% in FX neutral terms. Items sold up 56%. Unit shipping cost down 17% in local currency, which means the free shipping rollout is working exactly as intended. Unique buyers hit 84 million, up 25% year over year, with Brazil buyer growth at a 5-year high. Fintech monthly active users, 83 million, up 29%. The credit portfolio grew 87% to 14.6 billion. Yes, that creates near-term provision headwinds. They're booking more expected losses up front on a much bigger book. Management said 2/3 of the margin compression is mechanical. It's math, not deterioration. Now Q2 is going to have more pressure. They rolled out seller promotions late in Q1, so the full P&L impact flows through this quarter. And yes, Amazon is pushing harder into Brazil and Mexico. But here's what Meli's own data shows. Brazil conversion rose year over year. Frequency is up, multi-category shopping is up, retention is up, NPS is up, competition is growing the pie, and Mercado Libre is taking a bigger slice. To me, this is a classic case of the market confusing short-term investment with long-term weakness. Great companies pay a short-term price to secure long-term dominance. That's not a problem. That's the strategy. Is Meli expensive? On trailing numbers, yes. On where this business is heading in 3 to 5 years? In my opinion, absolutely not. I think this is one of the best opportunities in the market today. Meta. As long as this stock stays around $600, to me it's a buy. Simple as that. And I know, the market doesn't love the CapEx story right now. Heavy infrastructure investment, free cash flow estimates going negative for multiple quarters this year before snapping back. That pattern scares people. But here's what I remember. We saw this exact same thing 2 or 3 years ago. Meta went down massively. Free cash flow went to near zero. And then, flip of a switch, the business went absolutely vertical. We went from $150 to closing in on $400 just 1 year later. That's what happens when a capex cycle matures. Trading PE right now? 22 times. Forward is about the same. Price to free cash flow is elevated because of the investment cycle. But the core business? Insanely profitable. The moment capex growth decelerates, you will see a very fast re-rating. The risk here isn't that Meta breaks. The risk is that you wait too long and miss the flip. Is Meta undervalued today? In my opinion, yes. And I've been adding to my position. Now let's talk about one of my biggest winners, and honestly a company I don't talk about enough because I just let them execute. Rocket Lab is up 26.5% today, closing in on $100 per share, $57.5 billion market cap. And yes, by conventional metrics, this is an expensive stock, but you are not paying for today. You are paying for what this company becomes. Here's what they actually reported this week. Revenue up 63.5%, $200.3 million, above the high end of guidance. Gross margin 38.2%. Backlog $2.2 billion, up 20% quarter over quarter and up 108% year over year. Liquidity over $2 billion, and then the launches. 31 Electron and HASTE missions booked in Q1, the highest quarterly launch bookings in company history. 5 dedicated Neutron launches signed, the largest contract in Rocket Lab history. 8 successful launches year to date, putting them on track to beat last year's record of 21. But here's what's really making the stock move. 3 new catalysts this week alone. They booked 3 dedicated HASTE launches with first mission no earlier than November 2026. They were selected alongside Raytheon to demonstrate advanced capabilities for the space-based interceptor program under the Golden Dome initiative. And the Minuteman acquisition closed, adding robotics and spacecraft mechanisms used on NASA's Perseverance rover. This is what I've been saying about Rocket Lab since we first covered it at a $4 or $5 billion market cap. They want to be the one-stop shop for everything space. Launches, spacecraft components, government contracts, commercial satellites, all of it. And quarter by quarter, acquisition by acquisition, contract by contract, that's exactly what they're building. Am I chasing it at $100 today? No. I already own a position, and I genuinely regret not adding more when it pulled back to $50, $60. But long term, this is a business that could be worth multiple hundreds of billions of dollars. And we haven't seen a single Neutron rocket launch yet. That's all still priced in as potential. When it becomes reality, the story changes dramatically. Quick one for the comments. Which of these 3 names interests you most so far? Melly, Meta, or Rocket Lab? Drop it below. I read every comment, and it helps me figure out which ones to deep dive on next. And if this breakdown is useful to you, hit the like button. It takes 2 seconds and it genuinely helps the channel grow. CoreWeave is down 12% today. The stock has roughly doubled since IPO and is up 42% year to date, so keep that in context. This is not a broken business. This is a business that reported very impressive numbers, and the market is grappling with one specific concern. Here's what they actually said. Revenue over $2 billion for the quarter. Up 112% year over year, up 32% quarter over quarter. Adjusted EBITDA margin 56%, that's down from 62% a year ago. Adjusted operating income at 1% margin versus 17% a year ago. And there it is, that's the issue. Now the backlog, close to $100 billion, they expect to recognize 36% of it over the next 24 months and 75% over 4 years. Customers include the Meta $21 billion commitment, a multi-year deployment deal with Anthropic, Jane Street added $6 billion in Q1, and HRT was named as a new customer. 9 of the 10 leading AI players outside China rely on CoreWeave. So why are margins compressing? Management walked through the 4 steps. They receive a PowerShell, 1 to 2 months of fit-out with no revenue. New deployments run at negative contribution margin during this phase. Month 3, revenue begins. And contribution margins normalize to the mid-20s as the install base grows. The drag from each new deployment shrinks over time. It makes sense when you think about it. They raised full-year CapEx guidance to $31 to $35 billion. Q2 interest payments alone are 650, 730 million. This is a company in full build-out mode. If margins start improving in Q2, Q3, Q4 the way management is projecting, this narrative flips fast because a near $100 billion revenue backlog is not imaginary. That's contracted. That's real. And if they can show that the business model actually works at scale, meaning margins improve as deployments mature, then $61 billion market cap looks very different from here. I still own CoreWeave, watching closely every quarter for that margin inflection. Now this one, I want to be straight with you because I used to own this stock. Irene is up 760% over the past 12 months. Year to date, still up close to 39%. Yesterday it was up 25% in after hours on an NVIDIA partnership announcement. By today, those gains had basically evaporated down to just over 4%. Why? Because when the actual earnings came out, you had to look past the headlines. The AI cloud business generated about $33 million in revenue this quarter, a meaningful increase quarter over quarter, but very small in absolute terms. And when you dig into the guidance they gave months ago, they told us back in November 2025 to expect AI cloud ARR of over $500 million by the end of Q1 2026. We are past Q1 2026. They are nowhere near that number. The NVIDIA deal, a $3.4 billion 5-year AI cloud contract, sounds great, about $700 million in ARR associated with it. But look at the actual structure. NVIDIA received a 5-year right to purchase up to 30 million Irene ordinary shares at a fixed strike price of $70. If Irene succeeds and the stock trades at $150 or $200, NVIDIA gets in at $70. That's not a massive confidence bet on Irene's future. That's NVIDIA getting cheap upside optionality. Of course they take that deal. The bigger question is this. If they couldn't hit the $500 million ARR target they set for Q1, a target that already had disclaimer footnotes saying it wasn't fully contracted, why should we believe the $3.7 billion exit rate for 2026? I'm not saying this to be bearish for the sake of it. If Irene executes, deploys 600,000 GPUs, and delivers on the build-out, this story looks completely different. But right now, execution is the exact problem. And when you can look over at CoreWeave and Nebius, which are delivering on their numbers quarter after quarter, the contrast matters. I sold because I was overexposed to the sector and because the disclaimers kept telling me what the big numbers wouldn't. Read the footnotes. Always read the footnotes. Last one, and this is the one I'm most conflicted about, in the best possible way. Shopify is down close to 29% year to date, up 18-19% over the past 12 months. Market cap $143 billion, trading PE 107 times, forward around 66 times. I know, those valuation numbers are scary, but let me ask you something. Is Shopify a company that gets disrupted by AI, or is it a company that benefits from AI? In my opinion, it's one of the biggest AI beneficiaries that the market is completely mispricing right now. Here's what they actually reported. Revenue up 34% year over year. GMV up 35%. Free cash flow margin 15%. Gross profit up 32%. Operating income $382 million. Monthly recurring revenue $212 million, up 16%. OPEX ratio 37%, down 4 percentage points year over year. Merchant solutions up 39%. Shopify Payments GPV grew 41% to $67 billion. ShopPay hit $35 billion in GPV, 59% growth year over year. This is not a company that's struggling to grow, but here's what's actually exciting. The AI numbers. 4 times increase in weekly active Sidekick users. That's their AI business assistant. 12,000 custom apps created in Q1 using AI tools. Around 50% of all Shopify flows built with Sidekick. 8 times increase in AI-driven traffic to Shopify stores. 13 times increase in orders from AI-powered searches. 2 times improvement in conversion from AI catalog search. Think about what that means. Every business that wants to exist in the age of AI shopping, where people search on ChatGPT, on Gemini, on Claude, needs to be on a platform that makes their products discoverable and shoppable in those interfaces. Shopify is building exactly that infrastructure. It's not just about SEO anymore. GEO, generative engine optimization, is the new battleground. And Shopify is 3 steps ahead. The conundrum here is simple. This is a great company, run by world-class operators, with multiple tailwinds. That is genuinely expensive. So, do you pay the premium now, or do you wait for a better entry? Honestly, I have it on the watch list. A DCF is coming and I'll go into the full bull case there. But at these prices, I want to see either a pullback or another quarter of clean execution before I get more aggressive. This is not a sell. This is a be patient and wait for your price situation. All right, let's bring this together. 6 names. Here's how I'd rank them in terms of conviction and urgency right now. Number 1, Mercado Libre. Great business. Being punished for strategic investment. Accelerating growth. The patient investor's dream. Number 2, Meta. Boring, but right. Premium business at a reasonable price going through a CapEx cycle that has a very clear endpoint. I've been buying. Number 3, Rocket Lab. This is the long game. Already a massive winner. Not chasing at $100, but the trajectory here is unlike almost anything else in the market. Number 4, Core Weave. High upside, real risk. Watching for that margin inflection every single quarter. Number 5, Shopify. On the watch list. Need a better price or another quarter of proof? And Irene? Watch. Don't chase. If execution improves, great. But the footnotes have been telling a different story than the headlines, and right now, that matters. Here's the big picture takeaway I want to leave you with. The market right now has a very narrow definition of what deserves a premium. If it's not AI infrastructure, if it's not memory, if it's not semiconductors, it doesn't matter. But markets are forward-looking over time, and eventually great businesses get recognized. The question is whether you're willing to own them before the rest of the world remembers they exist. I'd rather buy great companies when nobody wants them than pay full price when everyone does. That's been the philosophy. It worked with Google at $150, it's working with Meta. And I believe it's going to work with Meli, Shopify, and the others over the next 2 to 3 years. As always, this is my analysis based on my own research. Your situation, your risk tolerance, your time horizon are all different. Do your own homework. Never invest more than you can afford to lose. But if you're building a long-term portfolio and you're looking for quality, I think the names on today's list deserve serious attention. 3 things before you go. 1, if you got value from this video, hit the like button right now. It takes 2 seconds and it genuinely helps more people find this channel. 2, subscribe and hit the bell. We're doing this every week. Earnings breakdowns, watch lists, deep dives, you don't want to miss the next one. 3, drop a comment below. Which of these 6 names are you most interested in? Or tell me, what companies do you think are being unfairly left behind by the market right now? I want to know. See you in the next one.